The first dividend growth stock I have to highlight today is Enbridge Inc., stock ticker ENB.
Enbridge is a North American energy distribution and transportation company.
After merging with Spectra Energy Corp in 2017, Canada-based Enbridge became the largest energy infrastructure company in North America. Enbridge operates the world's longest and most complex crude oil and liquids transportation system. You might think energy commodities are too volatile to rely on, but that's not what's happening here.
Enbridge is basically an energy toll road, collecting fees no matter what.
Clients have to move their products, and pipelines offer a cost-effective way to do that. If you use these pipelines, Enbridge is going to collect those juicy fees no matter what the price of energy commodities are at any given time. Indeed, the company estimates that approximately 98% of its cash flow is predictable through regulated operations, take-or-pay contracts, or fixed fees.
It's been a successful model for decades already, and I don't see that changing.
Enbridge was founded in 1949. I think the staying power here is partially owed to the fact that Enbridge is mostly insulated from volatile pricing. It's a steady Eddie business that investors have been able to rely on for decades. And while the world is slowly moving toward more sustainable forms of energy that are friendlier to the environment, society's non-negotiable need for consistent energy means that oil and gas products will be necessary for decades to come.
That's what sets up Enbridge to continue paying and growing its reliable dividend for decades to come.
Already, Enbridge has increased its dividend for 28 consecutive years. That is in its native currency, which is Canadian dollars. Even more amazing, the dividend's compound annual growth rate over that period is 10%. Recent dividend raises have been in the low single-digit range, however, but with the stock currently yielding 7.3%, you just don't need much dividend growth in order to make sense of the investment. For someone in their 50s and looking for income to start covering the bills and offering the ability to slow down and live off of dividends at some point, that kind of yield goes a long way. This yield, by the way, is high even by Enbridge's lofty standards. It's 70 basis points higher than its own 5-year average. With the payout ratio at 65.1% based on midpoint guidance for this year's distributable cash flow per share, Enbridge's dividend looks to be as dependable as ever.
I'm surprised at how cheap this stock has gotten.
It's been totally ignored by the market all this year. Of course, when you're running a boring pipeline business focused on consistent cash flow and the rest of the market is infatuated with artificial intelligence, maybe we shouldn't be too surprised. The stock's 5% year-to-date decline against the market's near 20% rise may have created a great long-term investment opportunity, especially for older income-oriented dividend growth investors. Since you want to value a pipeline business like this based on cash flow, the current price to cash flow ratio of 7.7 is well below its own 5-year average of 9.7. Enbridge is never terribly expensive. It's mature. Growth is limited. On the other hand, it's a cash cow, and that cash cow is unusually cheap right now. Take a look. The second dividend growth stock to go over today is Main Street Capital Corp., stock ticker MAIN.
Main Street Capital is a business development company.
A BDC like Main Street Capital is a financing/investment platform. Main Street Capital provides flexible private equity and debt capital solutions to smaller privately held businesses that, for whatever reason, can't get or don't want traditional financing options such as those available from a bank.
I think of a BDC like this as a great way for us regular investors to get exposure to something that acts like private equity.
After all, what do PE firms do? They primarily invest in private companies. That's what a BDC does. So if you have a portfolio that has plenty of defensive blue chips that are tried and true, a BDC like this one adds a little bit of spice to the mix. Main Street Capital goes out and makes investments in all of these small private businesses that you'd never know of or profit from.
And profiting from these moves is all Main Street Capital seems to do.
The BDC has net asset value, NAV, per share growth of 115% since its 2007 IPO. The company has almost $7 billion in capital under management. Investments have been made all over the US in all kinds of industries. The investment portfolio of nearly 200 companies is diversified across dozens of industries. An average investment size of $18.4 million protects the overall firm from any one single investment going sour.
There's nothing sour about this dividend.
The stock offers a monstrous yield of 6.8%, and that's before factoring in the supplemental dividends, which are aplenty. Main Street Capital typically pays multiple supplemental dividends per year. If we take the totality of all dividends paid thus far this year, the yield on the stock rises to 8.4%, and we're not even done with 2023 yet. Also, this dividend is paid monthly. Not bad, right? Certainly makes budgeting for expenses even easier. Main Street Capital also routinely grows the dividend. The dividend has been increased for 13 consecutive years with a 10-year dividend growth rate of 4.3%. If we run rate the most recent net investment income numbers, the dividend payout ratio is 62.9% on the regular dividend before factoring in those supplementals. For someone in their 50s, this is a nice income producer with a decent growth kicker.
The stock is currently priced at a premium to NAV, but it's been that way for years.
When trying to value a BDC like this, you'll want to look at net investment income, NII, or NAV. NAV is $27.69 per share as I shoot this video. The stock's pricing in the market is slightly above $40. So that's a pretty big premium. However, I've never seen Main Street Capital not get a premium to NAV. And that's been the right call. It's been such a steady performer across the board. Even though this is an income play, not a high quality compounder, the stock has a compound annual growth rate of almost 12% over the last 10 years, thanks to that massive monthly dividend with supplementals. For someone in their 50s thinking about getting the bills paid with dividends, Main Street Capital could make a lot of sense. The third dividend growth stock I have to tell you about is WP Carey Inc., stock ticker WPC.
WP Carey is a net lease real estate investment trust.
With a market cap of $14 billion, WP Carey is one of the largest net lease real estate investment trusts in the world. But this REIT isn't just about size, it's also about quality and diversification. The diversification in particular is really something.
The property portfolio here is somewhat unique.
Nearly 1,500 properties leased out to almost 400 different tenants. Nothing unique about that, right? Well, where WP Carey starts to separate itself from the rest of the pack is in type and location. WP Carey doesn't specialize in one type of real estate. Instead, its portfolio has industrial, retail, education, self-storage, government properties, etc. Regarding geographic diversification, WP Carey is truly global. About 61% of properties are located in the US, the rest are worldwide, although largely in Europe. WP Carey ranges from self-storage properties in the US to warehouses in Croatia.
I think this diversification has engendered immense staying power for WP Carey.
Real estate is a tough nut to crack. It's taken down a lot of pretty smart people over the years. However, WP Carey is currently celebrating its 50-year anniversary. It was founded in 1973. You simply cannot last for 50 years in the real estate game without running a quality operation. WP Carey's portfolio is currently 99% occupied, and almost every property has built-in rent escalations, with many of them tied to CPI. This REIT is built to last.
And that's why the dividend is built to last.
WP Carey has increased its dividend for 26 consecutive years. That's dividend aristocrat territory. Now, the dividend has been growing very slowly of late. Recent dividend increases have been in the 1% range, so it's just not moving very much. Even when inflation normalizes, that's not much growth. However, the stock yields a juicy 6.5%. If you're in your 50s and thinking about getting bills paid via dividends, that kind of yield is pretty appealing, right? The payout ratio is 79.9% based on midpoint guidance for this year's adjusted funds from operations per share. Pretty much in line with what I'd expect from a REIT. It's not growing super fast, but it's a big, safe dividend.
The valuation also seems to be indicating safety, as in margin of safety.
Outside of the pandemic crash of early 2020, this is the cheapest that WP Carey stock has been in 5 years. every single multiple is significantly off of its respective recent historical average. Take the price to cash flow ratio of 12.7, for example. If you're familiar at all with REITs, you'll right away know how low that is. This stock's own 5-year average cash flow multiple is 16, which in and of itself is not very high. W.P. Carey is a bit boring, it's not flashy, but it's been paying a very large and steadily growing dividend for almost 3 straight decades. For dividend growth investors in their 50s who are perhaps sensitive to income, W.P. Carey is a strong candidate for long-term investment consideration.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 3 dividend growth stocks to consider in your 50s. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.